Thought leadership from PwC's National Office.
Hello, and welcome back to PwC's Accounting Podcast. I'm Heather Horn. Today's episode is our next installment in our year-end mini-series, which covers a wide range of topics designed to help you through the year-end reporting process. In today's episode, we're turning our attention to the statement of cash flows and the practical challenges and key judgments that come with preparing it. We've released an episode on this topic at year-end for several years now, and each year it ends up being one of our most popular episodes. So even if this isn't your year-end, there's almost certainly something new you'll take away from this discussion. Joining us today for the conversation, I'm happy to welcome Chris Trudeau, a partner, and Suzanne Stefani, a director, both in PwC's National Office, who spent a lot of time focusing on the statement of cash flows. And I'm also happy to welcome back to the podcast Diane Stoltzfus, also a partner in our National Office, as the guest host for today's episode. With that, let's get started.
Chris, Suzanne, thanks for joining me today to talk about the statement of cash flows. This is another episode in our year-end mini-series, designed to help companies prepare for year-end reporting. But even if you're not closing out year-end, there's still plenty here to take away. Cash flows is a topic we come back to every year, and for good reason. It continues to be top of mind for the SEC. It's a critical tool for investors, and it's an area where we see lots of questions in the National Office. The FASB is also looking at some targeted improvements, and notably, it's been one of the top 5 areas of restatement for the past 20 years. With all that in mind, let's start with restatements. I know from speaking with you both that there isn't necessarily a specific classification topic that's driving this. It's more of a controls and process-related issue. Chris, what practical tips would you share with preparers to help avoid this issue?
Thanks, Diana. Yeah, if you maybe listened to some of our podcasts in the past, you may feel like I'm repeating myself because I am. But, it's kind of as we say, like the basic blocking and tackling. A lot of times the cash flow statement is kind of the secondary statement in the view of a lot of people. And so it doesn't necessarily get the same rigor when you talk about controls and process that, say, the balance sheet and the income statement get. And I think that leads to, certainly some of the issues that come up. A lot of times it's the kind of last thing in the reporting process. A lot of times it's a different team or individual that's preparing the cash flow statement, especially when you compare it to, say, the actual transactions, right? Think about like an unusual transaction or a non-recurring transaction that comes up. I think a lot of times there's a lot of focus on what's the accounting. And by the accounting, I mean the measurement and the recognition of the particular transaction. And not all the time does it go all the way to say, so therefore, what is the cash flow impact of that? And then the person or group that's preparing the cash flow statement doesn't have the benefit of all those conversations or analyses that were done around the transaction itself, and maybe loses a little bit of that knowledge. I know when Suzanne and I answer a lot of cash flow questions, a lot of times our first question is, well, how's the transaction accounted for? Because that helps understand and helps drive then maybe where in the cash flow statement it should go. A detailed understanding of the accounting is really helpful in thinking about what the proper cash flow classification is.
Okay, that's really helpful, Chris. So it's important to think about the whole transaction at once, both the accounting and the presentation implications, not thinking of them separately. So this would be more efficient and hopefully prevent some of these last-minute fire drills we sometimes see around the cash flow statement. This concept about thinking about the whole transaction and how it's reflected throughout the financial statements and the broader 10K is one of the themes that we've seen in some of the recent SEC comment letters. Chris, I think it'd be helpful if you can share some examples of some of the comments that we've seen.
Sure. So you're right. There have been a lot of comments that have come up in this year and in past years around the cash flow statement. One of the, if you want to call it a theme, like I'm not sure there's a lot of themes per se, but if you want to call it a theme, it's consistency. And what I mean by that is the SEC may be reading the financials and, we'll come back to the unusual or non-recurring transaction, right? Because that tends to get a lot of disclosure and transparency throughout the financial statements. And so they'll see, XYZ disclosed in one section, and they'll say, oh, let's see what is in the cash flow statement. and they either can't find it in the cash flow statement or the numbers are different in the cash flow statement versus what was disclosed. And there could be a very valid reason for that. But the SEC will ask the question, like, why was it X over here, but in the cash flow statement it's Y, or it's not even in the cash flow statement? So one thing that we may recommend is to think about if there are kind of either inconsistencies or it's just not apparent on the, why the cash flow would be consistent with the disclosure, is think about a little bit more transparency around the transaction and maybe bridging that gap. So I think at the end of the day, that's all it is. It's just there's a non-cash piece to it. And so that's what's causing the inconsistency between the two. MD&A is another area. Now I know that's not necessarily, you talk about the national office, we don't really deal with the MD&A portion of it per se, but we are aware that there's often a lot of comments around the MD&A. And I think that gets down to more the purpose of the disclosure in the MD&A. It's usually in the liquidity section. And oftentimes what the comment is that the preparer simply restated everything that's in the cash flow statement in the liquidity section. So if you think about it, not overly helpful because I could just read the cash flow statement.
Right.
I don't need, the liquidity. And the purpose of the liquidity is supposed to be more like what's going to impact your liquidity, maybe even from a going forward perspective. And so the comment is often to do more, go beyond what's just in the cash flow statement, but really talk about what's driving your cash needs, what will drive your cash needs, and where are your sources of cash coming from. That's the gist of what the comments are from the SEC, or said differently, the recommendations on how to fix it going forward.
Right.
And what's interesting is we've seen this year a lot of comments around disaggregating the cash flow statement, specifically around the operating section. So you may be aware there's two choices in preparing the operating, the direct and the indirect method. And for the 99.99% of the companies out there that use the indirect method, it's basically just a reconciliation from your net income to your operating cash flows. There's not a lot of real guidance in terms of like what must be disclosed when you're doing that, just that you need to reconcile, and maybe some guidance around what is in the operating section. But, doesn't really say you must disclose in a fashion that says here's XYZ disaggregated out. And I think consistent with the SEC conference in December, the SEC is looking for a little bit more in terms of the cash flow statement in general. But again, the comments have been more on this reconciliation to, hey, if there are some significant items in there, break it out so the reader can actually understand a little bit more about what's going on.
Right. I mean, I think to your point, Chris, the SEC continues to focus on the statement of cash flows. You mentioned the conference, but we've seen statements over the years from them as well, continuing to reiterate how important this statement is and how they want to make sure that investors are getting sufficient information to assess a company. So definitely something for companies to think about as they prepare their cash flow statement this year. So let's shift to some of the frequently asked questions we get in the national office. We've seen a good deal of debt restructuring activity this year, and with that, plenty of questions around how those transactions show up in the cash flow statement. Suzanne, what are some of the common questions you're getting?
Yeah, a good deal of the questions that we get for debt restructuring in general, even for the accounting, is around syndicated debt restructurings, but for the cash flow too. And I would say the number one question is, how do you present the new debt proceeds received and old debt repayment? So typically, right, what we see is like a company will issue new debt, get the money, and take the proceeds and pay off old debt. And it's not just always as simple as just, oh, you have a financing inflow and financing outflow. It gets a little more tricky with syndicated. And sometimes we're using agents, like investment banks as agents and things like that. So like maybe just a quick example, I'll try it. And sometimes numerical examples are hard on these, but let's try. So say you're a company and you issue $150 million of new debt, and you immediately at the same time, same day, you're repaying existing debt, say like $50 million. And really common, you're going to use some sort of investment banker to act as an agent to kind of facilitate all the payments rather than you getting all the payments in from all the different lenders. So the agent will get all the proceeds from the $150 million of new debt, immediately take 50 out of those new proceeds and repay the old lenders. Then they would send, if it was me doing it, they'd send me whatever's left over, $100 million. So in my bank account at the end of the day, all I see is $100 million. So the question is, how do you present it on the cash flow statement? And I think like sometimes like kind of a knee-jerk reaction is, oh, I should just have $100 million financing inflow because that's what came into my bank account, right? I didn't see the whole amount or like repay. But what needs to be thought about here is we have an agent. In my example, I have an agent, right? An investment banker working for me to do these cash flows. And whenever I have someone acting as an agent on my behalf, I have to kind of, let's say, look through them. So like whatever they do, the agent does as far as cash flows, it's as if I did it myself, right? And so I should reflect all of that on the cash flow statement. So in this case, I would say, okay, I have a financing inflow for all the proceeds of the new debt, 150, and a separate line, financing outflow for 50 million for the repayment. So 2 lines, not the net, even though it does, I know it nets to 100, but like they have to be separate here. And I'm going to assume in this one that they're totally different lender groups too. So there's no way to net, right? Like different counterparties. So we just look through the agent.
Okay, got it. So you look through the agent. Since the agent was paying different counterparties, the amounts are presented as gross inflows and outflows.
Right.
And I think you've kind of mentioned this, but I know it gets more complicated when there's a debt restructuring and some of the lenders in the existing debt also come over and are part of the new debt. So maybe you can touch on that.
Yeah, so that's super common. So the first part I was talking about, kind of base case, like assume everybody's different, right? But it's not really true. In most cases, you'll have these lenders, we kind of call them rollover lenders, right? They're in the old debt and they're also in the new debt. And so those cases, the cash flow can get a little bit more complicated because it depends on how the cash flows actually worked, right? And you may need to do a lender by lender analysis. For the accounting, you always have to do a lender by lender analysis for those, but for the cash flow, it kind of depends. So let's take a little subset of my earlier example. Like say we have one rollover lender in there and they've got old debt of 5 million and new debt of 3, right? So they come down by 2 million. Now, there's different ways that the agent could settle them. One would be a net settlement. So it's kind of a lot of times referred to as like a cashless roll, where the rollover lender will roll 3 million into the new debt, no cash, and then they'll get paid out, in my example, for 2, because they went from 5 to 3. So in that case, the only cash that I didn't move it, but the agent moved it on my behalf. So I'll say the only cash that I moved was 2 million out, right? So in that case, we can only show for that lender a $2 million financing outflow. And so when it happens, when it's settled like this, you kind of have to look lender by lender at these rollover ones,
right?
To figure out what to do, given that no cash really moved from the gross amount. But oftentimes, there really is a gross settlement. Even though it's like the same lender, the same person, they'll really put in a new 3 million in my example, and then turn around and get paid 5. They are gross settled. And that's easier because you can just say, okay, it was really settled gross, so I can just show it gross. And that means I don't have to look lender by lender. I can lump these rollover lenders with the new lenders or the pay down lenders. That's the easiest option if you have a settlement like that to do that. Now, some companies will look to see if they should still be netting these rollover lenders even when they gross settle, because their thought is, well, it's really the same party and cash is kind of fungible, right?
Right.
So we have, our thoughts are that there's kind of a policy choice here. It gets a little more complex. So I said this earlier, the accounting is done lender by lender. And so back to Chris's point that you have to kind of understand the accounting here. So if you assess the accounting, and it's the 10% kind of debt restructuring, if you get to a situation where it's considered a modification, so like for accounting purposes, it's not new debt.
Right.
If you're in that scenario where that lender is a modification, that rollover lender, then you have a policy choice where you can show it gross if it's settled gross, but you can also show it net, in my case, 2 million. Although I think that many choose not to do that just because it's, it's a little more work because you're going to be looking lender by lender for the cash flow statement. And B, doesn't always, I'd say companies like to see like that gross proceeds of the whole new debt and repayment. It just makes more sense sometimes for the user.
Right.
But it's a policy choice. So it depends, what you want to do there. And I'd say it's something you have to establish and apply consistently to every restructuring that you have.
Okay, got it. And for anyone looking for more detail, there's a great example of a syndicated restructuring in Chapter 6 of our financial statement presentation guide. Okay, so let's move on to another area where we're getting a lot of questions, payment processing. Chris, can you walk us through what we're seeing there?
Sure. And I think we use the term payment processing, like, the different kinds of companies that are out there may call it something different, funds processing, payments transfers, whatever the case is. But, at its core, it's the different types of businesses that will transact with a customer, maybe be a go-between between the customer and a merchant, say, and they are there to facilitate the transaction. So they'll take the customer funds, they'll send it through to the merchant and be a settlement company. That's another term that's used for some of these folks. And we see them all over the place, right? So, you may hear the word fintech. That's generally, kind of a catch-all for a lot of these, but they could be technology companies. They could be financial institutions or lending companies, combinations of the two, and anything else, to be honest with you. A lot of these are coming up as ancillary type businesses to help with the, core business somewhere else. So there are companies that do this as that's their bread and butter, and then there are companies that do this as kind of a additional service to provide. But, like I said, the basicness is that I'm going to collect funds from one customer who's looking to, buy product A, and just be that go-between person. Sometimes I may even tack onto that and help facilitate by offering some kind of short-term lending or something like that. But that's a whole other ball of wax. So we get a lot of questions on that, especially over the last couple of years. We talked about the SEC conference. Well, it wasn't so much this year, but last year's conference, this was a big topic at one of the sessions at that conference. So over the course of the year, we've gotten a lot of questions about that. And it's generally going to be, two areas. I mean, one is which of the three, cash flow categories should it be in: operating, investing, or financing? And, we do see ways to get to maybe one or two different spots. I think when asked, we think is the best presentation is to put it into financing. And the reason being is that you're basically, when you're collecting the money from the customers, you're kind of short-term borrowing that money. You may be able to earn some sort of float or something.
Sure.
Obviously, you're charging a fee for the service you're providing as well. But you have some sort of temporary use of that funds. Could be as short as, minutes or hours, could be overnight, could be, hold on to it for a month. It kind of depends on what your settlement agreements are with the merchants. But in any case, it's more akin to like a short-term use of somebody else's money. And then obviously when you collect it, it would be a financing inflow. When you finish the settlement process or you remit the funds, it becomes a financing outflow.
Right.
But like I said, there are potentially, other views and other places it can be. We would suggest, doing your assessment and your analysis and try and use your best judgment. But when asked what we think the best is, we'll always say financing.
Okay, got it.
The second part is then gross versus net. Do I have to show each one of these transactions on an in-out basis, on a gross basis? If you think about like the hundreds, thousands, maybe even millions of transactions that could get processed, that could be a lot and have a really big number on your cash flow statement. But what we say is, well, if you use the general netting guidance, which usually is if the maturity is 3 months or less, you can net. Think about it in terms of what's the remittance requirement. So if when collected, part of your agreement with the merchant or whoever is your customer on the other side, if the remittance period is 3 months or less, you can kind of view that as the maturity and apply a netting concept to that. So that makes it a little easier. You just need to kind of know what the net in, net out was over the period you're talking about and show it on a net basis. If you want to, there's never any wrong answer in saying gross. So if you're not sure, gross is always acceptable in the cash flow statement. It's just may not be the one that you want to do. What's interesting is that this year, a lot of our questions have been on companies that may have had it in operating as an example, because they say, well, this is my business, this is the quote we're doing operating. But we're seeing more and more people putting it in finance. I will not take any credit to say that's because we're telling people that's what the best. But nonetheless, so we got a lot of questions this year about like reclassing on cash flow statements. So we have seen, if there was any kind of trend here, more companies maybe going more to the financing than we had in the past.
Okay, that's really helpful. Another thing we've seen is a lot of business combination activity recently. And these transactions can generate a lot of different types of cash flows, which naturally leads to a lot of questions. So, Suzanne, let's walk through a few. First up, how should cash paid on the acquisition date be classified?
Yeah. And we have gotten, I did search kind of all the consoles for the year, and this was like, the FASB was the number one topic. So it's good we're chatting. But yeah, so cash paid to the seller. So you're buying a business, even though once you buy that business and you bring everything on your balance sheet, you're going to have like lots of changes on your assets, liabilities on your balance sheet. The unit of account for the cash flow statement is just the acquired business as one, right? So the individual balance sheet line changes are not, because of the BizCom, are not going to be shown on the cash flow statement if you're doing kind of the indirect method and all that. If AR goes up because you brought on acquired AR from the BizCom, you're not going to show that change in your reconciliation, but rather it's just going to be one line item for the cash paid to buy the business, of course, net of any cash you may have acquired, and it would go into investing. So it's just like the cash payment directly to the seller. Then there's transaction costs. If you incur transaction costs, those are operating because they're expensed. So they're not netted with investing. So a separate line, a separate point in operating. And then, of course, there might be non-cash transactions as well, where, you pay for the business, some portion in like stock, or you have some sort of contingent consideration liability or things like that. Could even be all non-cash, perhaps. And that would be just disclosing the non-cash component. So, but often there's like a combination, right? Cash. So don't forget the non-cash.
Okay, what about situations where the acquirer pays off the seller's debt as part of the business combination? How does that impact the cash flow classification?
Yeah. So often, right, the seller's debt is going to have some sort of change in control provision or something. So the debt gets paid off. And I think sometimes the bank wants the buyer to just pay directly rather than round tripping it to the seller, right? So yeah, so first we'll start with, you don't legally assume the seller's debt. And that's the most common situation, right? Because of these change in control provisions. So in that case, you're not bringing any debt on your books for that. So any funds paid to the seller's bank to extinguish their debt is just an investing outflow. It's really just part of consideration.
Okay.
You're just paying, instead of paying the seller, you're just paying their bank directly, right? So that's just investing. Now, in the more rare case, if you did in fact assume the seller's debt, then you're going to bring the debt on your books at fair value. And then really anything you pay on that debt going forward, because now it's your debt, would be a financing outflow. So later, right?
Yeah.
Yeah. On the acquisition date, you wouldn't in fact have any cash. You wouldn't have paid anything out at that point.
Okay.
That's similar to where we were talking before about like really understanding the transaction. Because when Suzanne and I and others in our group get these kind of questions, one of the things that we ask is, well, what would our business combinations teams say where it should get treated in the transaction? Is it part of the proceeds that Suzanne mentioned? Is it on the line of the business combination? Is it part of the step up, fair value and everything? And that kind of helps then drive, as Suzanne was saying, like if it's kind of, it's just part of the proceeds, then it's just part of the cash proceeds, right?
Yep.
Or if it's actually coming through and you're going to show the debt, on your books first, then once it's on your books, it's kind of your debt.
Yeah. Okay. So what if there's a pre-existing relationship that gets settled as part of the business combination? So for example, let's say the buyer has an outstanding payable to the seller for inventory purposes, and that payable is settled as part of the deal. How is that handled?
Yeah. So that's, again, like understanding the accounting. So if the buyer had AP to the seller because like they bought inventory. And now since they're buying the business, they're kind of doing two things. They're paying cash, right?
Mm-hmm.
For two things. They're buying a business and they're settling their AP, right? So I think back to Chris's point for the accounting, you're accounting for two things. And so just in general, like often this comes up not just in BizCom, but where you cut a check and you're doing two things and there could be two different classes of cash flows. There's guidance in the cash flow guidance for when this happens that it says one, look to see if there's specific cash flow guidance to tell you what to do. So here and now. So the second step is try to bifurcate that cash into separate identifiable uses, right? Or sources, and here in this case, use. And often the way we do that is we look at the accounting, right? So in this case, because we know the accounting is different, some of that cash paid is going to be for consideration for the business and some of it's going to be to settle the AP. You follow that. So like whatever was attributed to settling the AP is just like you're paying any other AP, so it's operating. And then the rest, which is attributed to business, the purchase price consideration of the business, then would then be investing. So it's just kind of, you don't just like blanket say like, oh, it's like most of it's for buying the business, so it's investing. Like you have to really look and kind of understand what's going on.
So Suzanne, your point's kind of like we were just talking about, right? So if you think about your AP, the company you're acquiring has an AR for this, hopefully the same amount, right?
Yeah.
And so in the business combination accounting, the guidance would not tell you to put the account receivable on your book at its fair value. It would say, no, that actually gets settled, right?
Right.
And so that's why we're saying follow the accounting. So since it's not going to be part of the AR coming on and then an intercompany elimination, it's, you're allocating the cash to first settle your AP, that goes away. And then you do your business combination accounting on the rest.
Mm-hmm.
Yep.
Seems like just continuing to reinforce the point that we've been talking about is really important to really understand these transactions.
Yeah.
Absolutely.
Yeah. And think about the cash flow at the same time.
Right.
Yeah.
Okay. One more in the business combination bucket. What about contingent consideration? How should that be treated in the statement of cash flows?
Yeah. So pretty common to see that, right? And the FASB actually put out some guidance some years ago now, I guess, on that. So if you have contingent consideration, right, on the acquisition date, the buyer is going to set up a liability for the fair value of what they think they're going to have to pay, right? So they put up some liability. That's going to be disclosed as a non-cash consideration on day one. And then as things change and this and that, they're going to kind of remeasure that liability, over time. And they remeasure it through the P&L, right? So when the payment is ultimately made to the seller, classification. So this could be like months down the road, right? The payment depends on two things: timing, when you make it, and how the amount compares to the original liability. So if you do end up, which is kind of rare, but making the contingent consideration payment within 3 months of the original acquisition date, it's considered soon after the VisCom date. And there's guidance that says payments made soon after the acquisition date are investing. So in that case, the whole amount would still be investing. Anything within 3 months of the acquisition date. If it's after 3 months, which is more the norm, then you say, okay, I'm paying this after 3 months. Any amount up to the original liability is financing, because that's like, okay, I put that as a liability on day one, like whatever I, pay on that, it's just kind of like debt. But any payment over the original liability, if you have to increase that liability, it goes to the P&L, right? That's how you get it larger. So anything that was recorded over the original liability is going to be reflected in operating. So it really depends on kind of when and what amount it was settled at. But I want to say something else that we've gotten some questions on over, I guess, the past year or so. There's sometimes we're seeing situations where it's like not even contingent consideration. It's just the way that BizCom is structured. The buyer doesn't pay for everything up front. Let's say there's a deal where they buy a business and they pay 50% of the consideration in cash up front. And there's a just set agreement that they're going to pay the remaining 50%, let's say, in 1 year. So no like contingency or anything. It's just
timing
like
of the payment.
timing, right? You're allowed to defer the payment. And so basically on the BizCom date, they're going to record that liability for the amount they're going to pay in the future. It's going to be non-cash. And when it's paid, it should be a financing outflow because it's more like financing than contingent consideration because it's a known amount.
Right.
And you're just paying the liability you established on the BizCom date. It's financing. I bring it up just because some people have asked us and we're initially thinking that it should be investing because there's not specific guidance for it. Whereas they're like, no, I get contingent consideration because the 230 guidance specifically addresses it. It doesn't address this specifically, but it's just that same concept, right? It's like it's like even more of a financing, I would say. So I just wanted to bring that up just in case anyone's dealing with that.
And Suzanne, isn't there like a general investment guidance or investing activity guidance that would say, think about more in terms of if I bought a building, like P&E, right? And would say the soon after guidance is there for that. So it would say,
exactly.
if I bought a building, but I paid for it, 6 months down the road because seller provided financing or whatever, then the ultimate payment would be, or the transaction would be a non-cash disclosure on the acquisition date. And then I would, put the cash flow through financing. So acquiring a business is just simply an investing activity. So really it's more looking at that guidance as opposed to the contingent consideration guidance, which would get you to the same spot.
Yeah.
Okay. Any other insights you want to highlight?
One other one that we've been getting some questions on, so I just want to bring up working capital adjustments. Get questions on where to put that. So sometimes you have to the buyer would have to make a payment. Sometimes they get a payment, it depends. Typically these are made during the measurement period and they're treated as adjustments to purchase price consideration. So in that case, if these working capital payments are made in the measurement period and they are in fact treated as an adjustment to consideration, they would be investing. And so you might be like, wait, why is this different than the one you just talked about with the financing? It is different because it's treated more like an adjustment of the purchase price. It's not like the seller was letting you finance the business and pay later. Like if you made a payment, it's not like you're just paying later because you wanted to defer some of the payment for cash flow, can keep your cash flow better. This is more like, there was an adjustment. I thought something was there at the acquisition date and there was it wasn't right, or there was some sort of adjustment. I'm not a BizCom person, but that's how I think about it.
Right.
And so it's more like, okay, so you're just adjusting like that initial amount that went through investing, but it's in a different period and you're going to put it there. So that's why we think that makes sense. And we have seen that come up a few times this year. So I just want to mention it.
Awesome. Okay, Chris, maybe turning back to you now on recent FASB activities. I know the FASB has a targeted improvements project focused on the statement of cash flows. Can you give an update on that?
Sure. And we may stretch the definition of recent because I'm not sure there's been a lot of activity on that since 2023, but nonetheless, there is still a project that ongoing for the statement of cash flows. Where the project currently is that there were some initial decisions made mostly on the impact to financial institutions. So if you think about a financial institution and think about what we've been talking about with, the cash flow statement, there's three basic classifications, right? There's operating, and then there's investing and financing, right? So take a bank for an example, right? What is a bank's operations? Investing and financing. So kind of can cover all three, right?
Right.
So today, generally, financial institutions will put their, investments in investing and their financings like deposits for a bank in financing, despite the fact that it's core to their operations, right?
Yeah.
And so that's what the project is kind of addressing or looking at, right? Because there's been feedback that would say, well, if I think about that for a financial institution, that doesn't necessarily give me the most useful information. So they're definitely taking a look at should, again, use a bank, should the loans that they make and the deposits that they bring in, should that just be an operating transaction instead of investing and financing? The second piece of the initial decisions has been on interest income. So if you're familiar with the cash flow statement, there's a supplemental disclosure around interest paid. But again, for a financial institution, interest received is kind of just as important as interest paid. And So they're looking at, should there be either within the body of the cash flow statement, required disclosures around interest received and or a supplemental disclosure to include interest received. So those are the two main components on the initial decisions made. The board still has then on its research agenda for should there be other improvements made in the cash flow statement. But, it hasn't been any near-term recent activity, but it still is a project that's on the agenda.
Okay. So mainly impacts financial institutions and see if there's any more to come from the FASB. I also saw that there was a new project added on stable coins. Can you tell us a little bit about that?
Sure. That was just added during the last quarter. I think it was in October of 2025. And it's, a start to address some of the questions on digital assets, right? So, in the grand scheme of everything, digital assets is still a very new activity that a lot of companies question, kind of, well, what makes sense from the accounting, the reporting, the measurement, and the presentation of those. And so the project is focused on whether certain digital assets and certain stable coins, more specifically, should be a cash equivalent. If you think about it, what's the difference between, say, a stable coin and a money market, which is typically included in cash equivalent,
Right.
At least in terms of how people use it, right?
Mm-hmm.
So that is what the board is looking at is, should those stable coins be treated as cash equivalents? And if so, under what guidelines? Like what does the stable coin need to demonstrate in order to be considered a cash equivalent?
Okay. Well, great project to be following. Thank you both so much for your insights today. This has been a great conversation. But before we go, any final words of advice to our listeners? Maybe Suzanne, I'll start with you.
Yeah, just I would say, we just touched on a few topics today. We get lots of questions in all sorts of areas, so it's a little bit hard to boil it down to catch something for everyone. But we have lots of these issues and more in our financial statement presentation guide. It's chapter 6, all cash flows. So I encourage listeners to check it out if they have questions.
Okay, great. Chris?
Yeah, so I'm going to take us back to the beginning, right? So where we talked about the restatements and the practical tips around what to do about that. So maybe a reiteration of what we said before. Don't wait. Think about the cash flow when you're thinking about the transaction. Don't leave it to the very end. Have good direct controls around the statement of cash flows and the cash flow presentation. And maybe one last thing that I would say is be mindful of non-cash transactions, because a lot of times just in the general preparation, it could be looking at change in assets and liabilities and believe that that's your cash flow.
Right.
But there was a non-cash component that happened during the year. So that could kind of throw off what you're doing. So be mindful of cash flow, non-cash transactions, and how it impacts how you're preparing the cash flow statement.
Well, great advice from both of you. Thank you so much for joining me today.
Thank you.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.